hear out what Sunil Koul, who's a global emerging market equity strategist at Goldman Sachs, had to talk about the themes, especially post the union budget.
We do think that on a relative basis, at a very aggregate level, you would see some outperformance from from the consumption cohorts compared to the Capex sensitive sectors. Again, within consumption, it's a broad category. Some of the discretionary consumption categories, I think QSR is a good example in point that could do well. I think there is a lot of focus on tourism, travel. I think that would continue to do well. I think footwear and some of the other discretionary categories, durables for that matter, also we think could benefit. So again, I think there are very pockets of consumption, discretionary consumption categories that could relatively do better compared to the very heavy sort of capex, government capex intensive sectors. We have been underweight cement, where we think I think we still have sort of challenges in terms of competitive intensity, but also kind of some pricing pressure. So cement is something we have been underweight. I think infrastructure, within infrastructure, where we are kind of more neutral, we have pockets of the broader industrials, airlines as a case in point, I think, which could do well. But I think sectors like infrastructure are very capex heavy, railways, roads. I think they can underperform in the current context. There's always been kind of premium valuations to Indian consumer stocks. I mean, compared to anywhere else in the EM, and at the peak, many of these consumer stocks, you can't sort of broadly overgeneralize, but they were sort of trading at 50, 60, 70 times PE. Market itself at the peak in September, before we just downgraded it in October, was trading at 25 times the aggregate market. From there, I think we have seen a decent pullback in the market, close to 15% plus. But when you look across categories, including in consumption, you're seeing sort of 20% plus multiple deratings in many of these stocks. So our sense is that you're getting to a level in aggregate terms where market is getting sort of more fairly valued. I mean, within that, I mean, for the headline market overall, we've sort of gone from 25 to 22 times PE, and our sort of fair value target is more like 21. A lot of FII is still kind of engaged in the consumption story in India, and so it still will trade at a relatively higher multiple to the rest of the indices and rest of the consumer pack across the EM.
Manish.